Welcome to Talk Tickers. We're your shortcut to understanding what really matters from today's earnings calls.
That's right. We sift through the jargon so you don't have to.
Today, we're unpacking the latest earnings call. Looks like a story of pretty solid performance, actually.
Yeah, definitely some strength there, despite, the broader economic questions everyone's asking. Let's dig in.
Okay, let's hit the highlights first. The headline numbers. Revenue.
Up 8% year over year, FX adjusted. Make that 9% if you account for the leap year.
Got it. And net income.
$2.6 billion. So that's 3.64 cents per share.
Solid bottom line. What about card member spending overall?
That grew too, 6%. Or 7% without the leap year bump. So yeah, people are still spending.
And they're still acquiring new customers.
Real, yeah. 3.4 million new cards issued. And here's the interesting part.
Let me guess, the younger crowd.
You got it. Millennials and Gen Z made up over 60% of new consumer accounts globally. That's a big shift.
Wow, over 60%. That's definitely noteworthy. Anything else jump out on the acquisition front?
Card fee revenue. It was up a huge 20% FX adjusted.
20%. So people are signing up for, and presumably valuing, those fee-based products.
Exactly. Seems like the premium strategy is working there.
Okay. And looking ahead, guidance.
They held firm. Full-year revenue growth guidance is still 8% to 10%.
And EPS.
Also maintained $15 to $15.50.
So despite everything, they're projecting confidence.
Did they comment on the core health metrics? Like retention, credit?
Yeah, they specifically said spend, retention, and credit performance all remain strong and, importantly, stable through the quarter.
Okay, good baseline. Let's dive deeper then. What exactly was pushing that revenue growth?
Well, a couple things. Goods and services spending actually grew faster than last year.
Faster, okay.
Yeah, and T&E, travel and entertainment, that growth was steady.
Steady T&E. Any nuances there?
Yeah, strong performance in restaurants and lodging kind of balanced out a bit of a slowdown in airline billings growth compared to the previous quarter.
Oh, okay. So maybe shifting within T&E, sort of. But interestingly, that high-end airline spend, front of cabin tickets, still very strong, up around 11%.
11% on premium air travel. That tells a story about who's still spending confidently, doesn't it?
It certainly seems to. And internationally, the picture was also bright.
How so?
International card services spend grew a robust 14%, and they saw double-digit growth in their top 5 international markets.
14%. So good geographic diversification in their growth.
Definitely. And back to those card fees we mentioned, record levels, it's not just new people signing up.
It's what they're signing up for.
Precisely. Around 70% of those 3.4 million new accounts were for fee-paying products.
70%.
And get this. The average card fee per new account they acquire, it's up roughly 40% over the last 3 years.
40% higher average fee. Wow.
Yeah.
So a real focus on premium acquisition.
Absolutely. It's not just volume, it's value. And another driver was net interest income.
Right, the lending side. How did that look?
Up 11%, FX adjusted. And notably, it grew a bit faster than their actual loans and receivables. Meaning their net yield improved. They're essentially earning more on the money they lend out.
Okay, efficient management there. Let's shift to the customer base itself. We touched on millennials and Gen Z. Unpack that a bit more.
Sure. So overall, premium customer spending was healthy. No signs of major pullback there.
And within the U.S.?
Affluent U.S. consumer spending specifically was up 8%. Solid.
But the big growth story was?
Millennial and Gen Z. In the U.S. consumer business, their spending jumped about 15%.
15%. And what share of the total spend do they represent now?
About 35% in the U.S. consumer segment. It's becoming quite significant.
And internationally?
Even stronger growth there, up 22%. And they actually make up an even larger slice of the pie internationally.
So this demographic is clearly key to their growth trajectory.
No question. Now, combined, their total spend is still maybe 20% less than older generations.
So closing the gap fast, it sounds like.
Yeah. Exactly. And importantly, these aren't subprime borrowers they're bringing in. The average FICO score at acquisition for this group is 750.
750 average FICO. That's strong. So growth and quality.
That seems to be the goal. Other segments. Commercial services spend was up a more modest 3% year over year.
Okay.
And they noted something interesting in the U.S. small and mid-sized business space. USSM spending at wholesale merchants saw a slight pickup.
Any theories on why?
They floated the idea that maybe businesses were buying inventory ahead of potential price increases.
Could be. Did they give any real-time data, like for early April?
Just a little bit. First week and a half of April, they said overall spending levels look pretty consistent with Q1.
Across the board, goods, T&E, customer types.
Yeah, pretty stable. They did mention a slight tick up again in small business spending right at the end of March and into early April.
Okay, so no sudden drop-offs post-quarter end. Good to know. Now the big one, credit quality.
The message was excellent. Both delinquency and write-off rates are still below pre-pandemic levels.
Below pre-pandemic. That's still holding up really well.
It is, and flat compared to last year. And here's another interesting data point.
Go on.
For customers they've acquired in the last 24 months, their delinquency rate is about 30% lower than the equivalent cohort back in 2019.
30% lower for new customers versus pre-pandemic. That speaks volumes about their underwriting, doesn't it?
It really does. And because of this strong quality and their macro view at the time, they actually had a small reserve release in their provision expense.
Releasing reserves rather than building them.
Okay.
Let's talk expenses. How are they managing the cost side?
The main metric they watch, VCE to revenue variable customer engagement, was 43%.
43%. And how did the components look? Rewards.
Rewards expense was up 16% year over year, but there's a caveat.
Riches.
They were lapping a period last year where they had a benefit from some model changes. So that comparison is a bit skewed. They expect rewards growth to look more normal for the rest of the year.
Got it. So underlying trend isn't necessarily a 16% run rate?
Correct. And they highlighted that marketing and operating expenses are still providing leverage, growing slower than revenue.
Always good to hear. And they stressed flexibility.
Yeah, emphasized that their model allows them to pull back or lean into expenses as needed, depending on the environment.
Makes sense. Okay, capital. How are they deploying it?
C1 ratio, their key capital measure, was 10.7%, nicely within their 10-11% target range.
Healthy position. Returning cash to shareholders.
Yeah, $1.3 billion returned in the quarter.
How is that split?
About $0.6 billion in dividends and $0.7 billion through share buybacks.
And didn't they just hike the dividend?
They did. A pretty significant 17% increase. That's a strong signal of confidence.
17% increase plus buybacks.
And ROE.
Strong, 34% for the quarter.
Okay, so solid capital position, returning cash, generating good returns. Let's circle back to the guidance and their outlook, especially the macro assumptions.
Right, so guidance held steady, 8-10% revenue growth, $15.50 EPS.
But they did adjust their economic forecast. Slightly, yes. The guidance now incorporates a peak-weighted average unemployment rate assumption of around 5.7%.
Which is higher than before.
Yeah, higher than their outlook last quarter, but their commentary was interesting.
How so?
They believe that level of unemployment, should it occur, would disproportionately hit white-collar jobs.
Which aligns more with their core card member base.
Exactly. So while acknowledging a tougher potential environment, they seem to feel their specific customer base might be more resilient than the overall average.
Interesting framing. And their overall confidence level.
High. They really leaned on the idea of their differentiated model. The global premium base, the revenue mix being less reliant on pure lending, the expense flexibility, their strategic investments, all things they believe help them navigate different economic cycles.
Okay. And speaking of strategic investments, any updates on acquisitions or tech?
Yes. They recently closed the acquisition of Center.
Center. What do they do?
Expense management solutions aimed at small and mid-sized businesses. It fits into a broader strategy they have been pursuing.
Building an ecosystem, it sounds like.
Exactly. Think Cabbage, Impendo, 1AP. These previous acquisitions are all about building out capabilities for SMBs, increasing their relevance.
Makes sense. And ongoing tech upgrades, product refreshes, still full steam ahead.
That was the message. They said short-term economic worries won't derail those long-term priorities. They mentioned doing over 150 product refreshes in the last 5 years.
On 50.
With more coming. And they tied any fee increases directly to delivering, real enhanced value back to the card members.
Value for fees. Okay, that's a comprehensive rundown. Ready for our This Is Not Financial Advice segment?
Let's do it. Outrageous but plausible trade ideas based on this call. You first.
All right. Idea number 1. Given the persistent strength in premium travel, that 11% jump in front of cabin spend, and just the general resilience of affluent consumers noted here, how about going long luxury travel operators or maybe high-end hotel chains? It kind of flies in the face of recession fears, but it leans into what this company's actual data is showing about their core customers prioritizing experiences.
Ooh, I like that. Contrarian based on headlines, but aligned with the specific data. Okay, my turn. Outrageous idea number 2.
Lay it on me.
Focusing on that huge influx of millennials and Gen Z, over 60% of new accounts, right? And we know T&E is strong, especially restaurants for that group.
Right.
So what about a speculative long position in innovative restaurant technology companies, specifically those focused on loyalty programs, digital ordering, enhancing the dining experience?
Betting on the tech powering the places the demographic likes to spend.
Exactly. It's a bet that this company's focus on acquiring these younger customers will ripple through and accelerate tech adoption in the dining sector, driven by those customer preferences.
Interesting angle. Playing the demographic shift via the tech enablers. Okay, 2 outrageous but plausible ideas on the table.
Just ideas, of course, not recommendations.
Absolutely. This is purely for discussion, not financial advice. Always do your own research.
Couldn't agree more.
Well, that wraps up our deep dive into this earnings call. We've hit the key numbers, the trends, the strategy, hopefully giving you some valuable perspective.
Yeah, lots to chew on there. What stood out most to you? We'd love to hear listener thoughts, too.
Definitely. Join the conversation online. Thanks for tuning in to Talk Tickers.
Until next time, keep digging deeper.